I have been watching something over the past few months that most people have completely overlooked. It is quiet. It is subtle. It is not the sort of thing that makes headlines. But if you understand markets, if you understand cycles, if you understand how institutions behave when they are under real strain, then you recognize this as a signal. And signals matter more than noise. What caught my attention was not a dramatic market crash or a bold announcement out of Beijing. It was something much smaller. It was the sudden silence of a giant. China, for the first time in decades, began restricting the release of key financial data. Local governments stopped publishing land sale figures. Banks delayed disclosure of loan performance. Property developers removed balance sheets that had been public for years. And when a system as large as China stops talking, well, an investor should always ask why. Countries do not hide good news. Companies do not bury numbers when things are going well. Silence is never a sign of strength. It is a sign of stress. And this particular silence reminded me of something you see before a company enters what we call a liquidity freeze. Not a collapse, not a crisis, but the quiet period when the people on the inside first realize that the numbers no longer add up, and they begin closing the curtains before anyone outside notices. That was the moment I knew something deeper was happening. Now most folks still believe China's financial story is the same one they have been hearing for decades. Relentless growth, strong central planning, endless reserves of capital. A government that can step in and fix anything. And that belief has held for so long that people stopped checking the fundamentals. They see tall new buildings, high-speed trains, booming exports, and they assume the engine must still be running smoothly. But every investor knows the outside of a company often looks fine long after the inside begins to crack. The signal I saw was not only the disappearance of data. It was the behavior of the people who actually run the Chinese economy. Over the past year, major banks quietly limited withdrawals. Local officials sent urgent notices asking state companies to buy unsold apartments. Provincial governments began issuing bonds not for development, but for survival. These are not the actions of a confident system. These are the actions of a system trying to buy time. When insiders begin acting defensively, that is when I pay attention. The moment that really caught my eye was when China's central bank injected liquidity into smaller regional banks without announcing it publicly. That is something you only do when you are worried about contagion. And contagion is a word no central bank ever uses unless they see dominoes starting to tilt. People forget that China's economic model is built on confidence. Confidence that property prices will always rise. Confidence that cities will always expand. Confidence that every loan made by the state will be paid back because the state stands behind it. But confidence is like oxygen. You do not notice it when it is there. You only notice it when it begins to thin. And in China, it is thinning. The quietest signal of all came from the households. Chinese families have stopped buying apartments. That is not a minor shift. In China, property is not just an investment. It is the foundation of savings, status, inheritance, and social stability. When families stop buying the one asset they have trusted for generations, something profound is happening beneath the surface. Families are always the first to sense risk. Long before Wall Street, long before rating agencies, long before central banks, so here we are. A country that once built more apartments than any nation in history now sits with millions of empty units. Developers who borrowed for decades cannot roll their debt. Local governments that relied on land sales have seen their revenue evaporate. And the institutions responsible for reporting this data have gone quiet all at once. I do not see that as coincidence. I see it as the opening chapter of a story we have not fully heard yet. We are not looking at a headline crisis. We are looking at the quiet beginnings of a structural breakdown. The first hints, the smoke before the fire. And if you study signals rather than noise, you see it clearly. China is showing the early symptoms of a financial system that has reached its limit. Now I'm not here to predict the end of anything. That is not how markets work. Systems rarely collapse all at once. They break slowly, quietly, piece by piece. And the first pieces always fall in silence. That silence is what brought us here. And that is where our story begins. When you examine a situation like this, you cannot start with headlines or market reactions. You have to begin with the structure beneath the entire system. You have to look at the incentives, the design, the machinery that keeps the whole thing running. Because in finance, breakdowns do not come from obvious shocks. They come from the way a system is built. And China's financial engine, impressive as it has appeared for decades, carries structural weaknesses that most of the world either missed or chose to ignore. To understand the current stress, you need to understand the foundation that supports China's growth model. For more than 30 years, China relied on a very simple formula: build, borrow, repeat. Growth was created through construction. Apartments, highways, bridges, stadiums, entire new cities. The government encouraged banks to lend. Banks encouraged developers to build. Developers encouraged citizens to buy. And local governments sold land to developers in order to fund their own budgets. This loop worked because every participant believed it would always work. A self-reinforcing cycle. As long as property values rose, the system could produce as much credit as it wanted. Households borrowed because they trusted the future. Developers borrowed because prices kept rising. Local governments borrowed because land sales seemed endless. And the central government allowed this expansion because it created the strongest economic boom in modern history. But there was a hidden flaw in this design. The system was not producing organic productive growth. It was producing credit-driven, construction-based growth. But buildings did not create wealth. Borrowing created the appearance of wealth. As long as more and more credit flowed through the system, the structure could stand. Once credit slowed, the structure became vulnerable. Every economy has some form of leverage. That is normal. The problem is not leverage itself, but where the leverage sits. In China, the leverage concentrated in three fragile places. First, the local governments. China has thousands of local governments that depend on land sales for more than half of their revenue. That works only as long as land demand continues. When developers stopped buying land, these governments faced an immediate financial hole. Imagine a company that relies on a single customer for most of its income. As soon as that customer disappears, the company becomes insolvent. That is what happened across the provinces of China. Second, property developers. For years, developers borrowed against future sales that never materialized. Entire business models were built on pre-sales. They sold apartments before they existed and used the money to build the next project. Once homebuyers lost confidence, pre-sales collapsed. Developers suddenly had no cash flow, no new financing, and unfinished projects everywhere. They had been running a treadmill that stopped while they were still sprinting. Third, households. Chinese families often put all their savings into a single apartment or sometimes 2 or 3. That is because China does not have a strong pension system. Property became the retirement plan, the savings plan, and the wealth plan combined. When home prices stalled, the foundation beneath household confidence began to crack. When home prices fell, even slightly, that confidence shifted to fear. This is the structure behind the current crisis. A financial system built on 3 pillars, all tied to the same asset. Local governments rely on property. Developers rely on property. Families rely on property. When one pillar shakes, the others shake with it. When all 3 shake at once, the whole system trembles. Now add one more piece of structure to the picture. China's banking system is not designed like Western systems. In the United States, banks fail and the market absorbs the fallout. In China, the banks are arms of the state. Their purpose is not profit, their purpose is policy. When the government wants growth, banks lend. When the government wants stability, banks slow lending. There is no independent risk assessment. There is obedience. That means banks carry enormous piles of loans that exist not because they were wise, but because they were instructed. So when the property market weakens, banks do not only face financial losses, they face political pressure to hide those losses. This is why data disappears. This is why disclosure slows. A system that depends on confidence cannot afford transparency when confidence becomes fragile. What you are seeing today is not a single crisis. It is the slow unwinding of a structural imbalance that was built over decades. A system that relied on endless construction now faces declining population growth. A system that relied on rising property values now faces hesitant buyers. A system that relied on controlled financial flows now faces capital moving quietly out of the country. And the most important part of this structure is the part that most people overlook. China cannot allow failure. In a normal market, failure clears out excesses. In China, failure threatens social stability. So the government steps in again and again. Rescue packages, hidden bailouts, emergency liquidity. But every time they step in, the structural imbalance deepens. This is why the recent silence matters so much. The system is not just under strain. The system is confronting the limits of its own design, that is the structure beneath the headlines. And understanding that structure is the only way to understand the story we are about to explore. When a financial structure begins to weaken, you rarely see the breaking point right away. You feel it. Subtle tremors. Quiet stress. Internal strain long before the outside world notices. But every system eventually encounters a moment when the pressure beneath the surface becomes visible. And for China, that moment arrived with the collapse of its most powerful property developer, Evergrande. Now Evergrande was not just another company. It was an empire. A giant woven into the fabric of China's entire economic engine. It built homes for millions. It borrowed from every major bank. It supported local governments through massive land purchases. It employed hundreds of thousands. It touched almost every financial artery in the country. When a company like that stumbles, it is not a company failure. It is a system alarm. The real shock was not that Evergrande collapsed. The real shock was that the government allowed it to collapse. For decades, the world believed that China had a simple, unwritten rule. Big companies do not fail. Especially companies tied to social stability. Especially companies tied to housing. Especially companies tied to millions of Chinese families. But in the summer of 2021, that rule cracked. Evergrande missed bond payments. It missed them again. Banks stopped rolling loans. Regulators stepped back. And the company that symbolized China's property boom entered a slow, painful unwinding. This was the first major signal that something deeper was wrong. Let me tell you why this moment mattered so much. In the world of finance, confidence is the most valuable asset. When people believe a company will survive, it can borrow, build, expand, recover. When they believe it will fail, no amount of cash or policy intervention can save it. Evergrande's collapse shattered a belief that had supported the entire property sector for decades. The belief that the state would always step in. The belief that developers could borrow endlessly. The belief that presales were safe because unfinished apartments would always be completed eventually. Once that belief broke, everything else began to shake. Homebuyers panicked. They stopped putting money down on presale apartments because they feared the buildings would never be finished. Developers depended on these presales to fund construction. Without them, cash flow evaporated overnight. Banks panicked. They quietly tightened lending standards. They stopped renewing developer loans that they once rolled without question. They became cautious not because the numbers told them to, but because Evergrande changed the psychology. And psychology in markets is stronger than math. Local governments panicked. They saw that developers were no longer bidding on land. Land sales had been their main source of revenue. Without land sales, they faced immediate budget gaps. Some provinces began borrowing through shadow financing channels. Others started selling assets. Others asked state-owned enterprises to buy land at inflated prices just to keep the books balanced. One corporate collapse triggered a cascade of fear across the entire system. And what made this shock even more powerful was the message it sent. The government was no longer willing or able to protect every major player. The safety net that had been assumed for decades suddenly had holes. And once the market sees holes in the safety net, trust declines faster than any policy can rebuild it. Evergrande's collapse also exposed something even more troubling. When regulators investigated the company, they found that many of its projects were unfinished, overpriced, or based on unrealistic land valuations. These were not accounting errors. They were signs of an industry that had grown too fast and too freely. An industry where growth was measured not by profitability but by scale, not by value created, but by value borrowed. When the first shock arrives, it often reveals the true condition of the system. And Evergrande revealed that China's property sector was not only over-leveraged, it was structurally unsound. The moment that really marked the turning point came shortly after Evergrande's default, when thousands of Chinese homebuyers in more than 100 cities began a mortgage boycott. These were ordinary families who had paid for apartments that were never completed. They refused to continue making payments on loans for buildings that existed only on paper. And this was unprecedented in China. Civil protest in financial form. It showed that the crisis was not just economic, it was social. When households lose trust, the system enters a stage that cannot be fixed with liquidity alone. Citizens were no longer willing to carry the burden of developer mistakes. They did something unthinkable in China. They pushed back. From an investor's perspective, this is the moment when you realize the issue is no longer business-specific. It is systemic. A system that relies on confidence cannot function when that confidence disappears from the household level. Evergrande did not break China's system. It exposed that the system was already breaking. It was the first major shock that revealed the cracks beneath the surface. The first indication that the safety net had limits. The first moment when the world saw that China's financial engine, long admired for its speed and scale, might not be as unshakable as it appeared. This was not noise. This was a signal, a very loud one. And it was only the beginning. The collapse of Evergrande was not an isolated event. It was the first crack in a wall that had been under pressure for years. And as every investor knows, the first crack is only the beginning. What comes next is the pattern. And when you start seeing the same stress appear across different parts of the system, that is when you stop looking at individual events and start looking at the structure itself. After Evergrande fell, the world waited to see if China would step in decisively. A decisive rescue, a full government takeover, a strong signal that the crisis would be contained. But what happened instead was something far more telling. One developer after another began showing the same signs of strain: missed payments, suspended projects, liquidity shortages. And the same pattern repeated almost perfectly. First came Casa, then Fantasia, then Shimao, then Sunac, then Country Garden, which for years had been considered one of the safer developers in the country. This was not coincidence. This was correlation. And in finance, correlation is a warning. It means the same pressure is hitting everyone at the same time. It means the issue is not bad management or poor decisions. It means the system itself is under stress. Let me walk you through what made this pattern so concerning. Each developer carried enormous debt, but for years they survived because they could always borrow more. As long as homebuyers trusted pre-sales, cash flowed in. As long as banks believed developers would be supported by the state, loans were extended. As long as land prices rose, local governments kept the machine running. It was a cycle that depended on one thing: forward momentum. When momentum slowed, the cycle reversed. Developers could no longer sell new units. Pre-sale revenue collapsed. Without pre-sales, they could not finish old projects. When projects stalled, homebuyers panicked. When homebuyers panicked, banks panicked. When banks panicked, local governments lost revenue. And when local governments lost revenue, developers lost their biggest buyers of land. Every part of the chain pulled the others down. What made the situation far more serious was the behavior of China's shadow banking sector. These are trusts and wealth management products that operate quietly alongside the traditional banking system. For years, they funded risky developers with high-interest loans. They filled the gaps that state banks avoided. And they made enormous profits as long as the property market kept rising. But after Evergrande collapsed, these shadow lenders began to face payment requests they could not meet. They had financed unfinished projects. They had promised returns based on assets that no longer existed. And they began defaulting quietly, one by one. That was the moment you could see the pattern extending beyond the property companies. It was now hitting financial institutions that had no cushion and no government guarantees. This is where the real stress began to show. When shadow banks pull back, developers lose their last source of liquidity. When developers lose liquidity, they stop paying suppliers. When suppliers stop being paid, they stop work. When work stops, entire construction zones freeze. And when construction freezes, social unrest begins. That is exactly what happened. Videos began circulating on Chinese social media showing construction sites abandoned, apartment towers left dark, and families standing in front of unfinished buildings demanding answers. These were not isolated protests. They appeared in cities across the country. The same emotional pattern, the same economic pressure, the same loss of trust. Inside the government, this created a second pattern. Local authorities began quietly issuing emergency instructions to state-owned enterprises. Orders to purchase unfinished apartments. Orders to buy land at failing auctions. Orders to support local banks. These were not public announcements. These were internal memos. Instructions given because central guidance was slow and the urgency was rising. When a system begins to rely on quiet, improvised support instead of planned policy, the situation is entering a more dangerous stage. Then came the clearest signal of all. China's central government began restricting negative financial reporting. Media outlets were instructed to avoid phrases like economic downturn, structural weakness, and property crisis. Local officials were told not to publish debt levels. Data began disappearing from public databases. This was not just pattern, this was confirmation. A system under stress starts controlling the information that reveals the stress. It reminded me of a company facing a liquidity problem. First, one missed payment. Then two. Then credit lines tighten. Then suppliers grow nervous. Then the company stops publishing detailed reports. Not because the reports do not exist, but because the numbers would cause more fear. Fear is the most powerful force in finance. It spreads faster than liquidity, and it spreads quietly at first. China's pattern deepening was not just about developers collapsing. It was about households losing trust, banks retreating, local governments scrambling, shadow lenders defaulting, and regulators silencing information. All of this happening across different sectors at the same time. No system breaks evenly. But every system that breaks shows a pattern before the fall. And China's pattern is now visible. It is not noise. It is not coincidence. It is the signature of structural stress that can no longer be hidden. The first shock was Evergrande. The second was the realization that it was not alone. And that is the moment when every investor knows the problem is not a company. It is the entire ecosystem around it. When a crisis reaches a certain stage, it stops being about individual companies and starts becoming a test of the entire system. Every major economy eventually faces a moment when its core institutions are forced to reveal what they are made of. In China, that moment is happening right now. And the most important part of this phase is not the property developers or the banks or the households. It is the institutions that sit at the center of the economic machine. The ones that are supposed to provide stability when everything else begins to shake. China has always relied on a very different institutional model from the West. In the United States, for example, banks maintain independence. Regulators maintain transparency and markets reveal stress openly. It can be messy, but it is visible. China built a model based on control, stability through central direction, growth through coordinated policy, information through selective release. And for decades, that structure worked because trust in the central authority was strong. The government said the system was stable and people believed it. But trust is not something you control. Trust is something you earn. And when a system reaches the point where numbers, disclosures, and independent assessments begin to disappear, trust does not strengthen. It weakens. The first institution facing this stress test is the banking sector. Chinese banks have always followed instructions from the state. When the state wanted growth, banks expanded lending at enormous speed. When the state wanted caution, banks tightened the lending. The problem with this arrangement is that banks did not develop the habit of saying no. They did not practice independent risk management. They did not learn to stand on their own. They followed orders. That works in stable times, but in times of financial strain, it becomes a weakness. Banks now carry large volumes of loans that may never be repaid. Loans to developers whose projects have stalled, loans to local governments that have no revenue, loans to shadow banking firms that cannot honor commitments. And because the banks cannot admit the scale of the problem, they roll these loans forward. They extend maturity dates. They restructure terms. They create new credit to cover old credit. This does not fix anything, it simply delays recognition. And delay in finance always increases the eventual cost. The second institution facing the stress test is the local government system. Local governments were the engine of China's growth model. They built the cities. They funded infrastructure. They controlled land auctions. But they also accumulated enormous debt through local financing vehicles. These are state-controlled entities created to borrow money off the official books. They built roads, bridges, tunnels, parks, and everything required for rapid development. As long as land sales were booming, they could repay their debt or at least service it. But now the land market has collapsed. Land auctions are failing. Developers have stopped bidding. And local governments are discovering that their budgets were not designed for this environment. Many now spend more on debt repayment than on public services. Some regions have delayed salaries for civil servants. Others have reduced public health budgets. A few have canceled major projects halfway through. These are not normal adjustments. These are signs of fiscal stress that have not been seen in China in decades. The third institution being tested is the central regulatory system. Normally, regulators provide clarity in a crisis. They publish risks. They announce losses. They enforce corrective action. But in China, regulators often respond to stress by reducing transparency. Debt data disappears from websites. Risk reports are withheld. Journalists are told not to write about certain topics. This might quiet public fear in the short term, but it increases uncertainty among investors, lenders, and households. When you cannot see the true state of the system, you assume the worst. That assumption becomes even stronger when regulators send mixed signals. One week they support developers. The next week they restrict developer borrowing. One month they promise to finish every stalled project. The next month they limit mortgage support. These actions reveal not a coordinated plan, but an institution responding to pressure as it appears. And that is never a sign of strength. The fourth institution under strain is the central government itself. For years, Beijing managed crises through decisive command. They could direct banks to lend, direct developers to build, direct provinces to spend, and direct households to trust. But this crisis is different. It touches too many layers. It involves too much debt. It affects too many families. It reaches too deeply into the structure of the economy. Top-down control works best when the problem is contained. When the problem is everywhere, control becomes harder to apply. This is the essence of a stress test. A stress test does not ask whether an institution is strong in good times. It asks whether the institution can maintain public trust when the numbers turn against it. And in China's case, the institutions that once projected total confidence are beginning to show signs of strain. Some of these signs are small. Quiet liquidity injections into regional banks, silent directives to state firms, unannounced bailouts, pressure on media outlets to avoid negative stories, and the disappearance of key financial data. Other signs are more visible. Mortgage boycotts, empty housing blocks, deficits in local government budgets, slowdown in consumer spending, and rising capital outflows. Together, these signals reveal something important. China is not facing a single crisis. China is facing a full institutional stress test. And the outcome of that test will determine not only the future of its financial system, but the future of its entire economic model. This is the stage where systems either regain balance or move closer to a deeper break. And that is what we will explore next. When a financial crisis reaches the level of institutional stress we discussed earlier, it does not stay contained inside the institutions. It travels. It spreads through the economy in ways that most people do not see right away. And the first sign of that spread is not found in stock markets or headline numbers. It is found in behavior, the behavior of households, the behavior of businesses, the behavior of governments. Once trust begins to weaken, the ripple effect starts, and it moves quietly through every corner of the system. One of the first ripples appeared in household spending. Chinese consumers are often portrayed as strong and resilient, but they are also cautious and deeply influenced by economic signals. When people hear that property developers are struggling, when they see unfinished buildings, when they watch friends or neighbors lose deposits on apartments that never get built, their natural instinct is to protect themselves. They slow spending. They increase savings. They avoid new commitments. This shift in behavior reduces demand across the entire economy. This is not a small issue. China's growth model has been trying to transition from investment-driven to consumption-driven for years. But consumption cannot grow when households feel uncertain. When families fear that their main asset, their home, may not hold its value, they tighten their wallets. They delay buying cars, appliances, electronics, vacations, even everyday goods. And when a population this large reduces spending all at once, the impact is enormous. The second ripple appeared in the business sector. Businesses rely on consumer demand. When demand slows, they produce less. When they produce less, they cut costs. That often means reducing hours, freezing hiring, or delaying wage increases. And when wages stagnate, households spend even less. This is how a ripple becomes a loop. A negative cycle where caution leads to slowdown, and slowdown leads to more caution. Many small and medium-sized enterprises in China have already begun to feel the pressure. These businesses depend heavily on bank loans or local financing channels. But when banks become cautious, when lending standards tighten, when credit becomes harder to access, small businesses suffer first. They have fewer resources and fewer protections. And when small businesses struggle, local economies weaken, jobs become insecure, and the ripple effect strengthens again. A third ripple appeared in China's export sector. For decades, exports were one of the strongest engines of China's growth. Factories produced goods for the entire world. But the global economy has slowed. The United States and Europe have reduced consumption. Supply chains have shifted. And some companies have started diversifying production away from China. This does not mean China is losing its manufacturing base, but it means the export engine is less reliable than before. Combine slower exports with weaker domestic consumption, and you have a dual pressure that hits the economy from both directions. The fourth ripple showed up in China's financial markets. When local governments face revenue shortfalls, they issue bonds to cover their expenses. But as confidence weakens, investors become hesitant to buy those bonds. This forces interest rates higher, which increases the cost of borrowing. Local governments then struggle even more, and the risk of default rises. When investors sense this risk, they move their money into safer assets, or out of the country entirely. China has already seen rising capital outflows. Wealthier families are moving savings into foreign accounts. Corporations are shifting assets abroad. This puts pressure on China's currency, which the central bank works hard to manage. A currency under pressure is another sign of stress. The fifth ripple is the impact on the banking sector. Banks sitting on risky loans begin to limit new lending. They become selective. They refuse loans to developers, to small businesses, to local financing vehicles. Reduced lending slows economic activity even further, and the confidence loop tightens again. This is the point when a credit-driven economy faces an unavoidable fact. Growth created by borrowing can continue only as long as borrowers remain confident and lenders remain supportive. When both sides hesitate, the cycle breaks. A sixth ripple appears in the job market. China does not publish full unemployment data for fear it may trigger public concern. But independent assessments show rising youth unemployment, stagnant wages in many regions, and job reductions in sectors tied to real estate and construction. The construction industry alone supports tens of millions of workers. When projects freeze, workers lose income. When workers lose income, spending slows further. If you look closely, you see a very clear and very familiar pattern. A pattern we have seen in other economies during major downturns. Slowing consumption leads to weak businesses. Weak businesses reduce hiring. Reduced hiring weakens household income. Weak income reduces spending, and the cycle continues. But the most important ripple is not economic. It is psychological. Economic slowdowns do not become crises because of numbers. They become crises because of fear. Fear of losing savings. Fear of losing jobs. Fear of uncertainty. Fear spreads faster than data. And in China's case, fear is amplified by lack of transparency. People begin asking questions that do not have clear answers. Is my bank stable? Will my home hold value? Will my local government pay its debts? Will my developer finish my apartment? Will my savings be safe? When people start questioning the foundations of their financial life, the ripple effect becomes a wave. What began with a few property developers missing payments has now moved through households, businesses, banks, local governments, and markets. This is not a contained event, it is a spreading pressure. A ripple that touches every part of China's economy and reveals how dependent the system has been on confidence. And this widening pressure sets the stage for something even more significant. Economic ripples become historical echoes. And to understand where China may be going, we need to look at where similar patterns have led in the past. That is exactly where we go next. Whenever a major economy enters a period of unusual stress, there is a powerful instinct to say that the situation is entirely new, unique, unprecedented, something the world has never seen before. But if you have lived long enough, if you have studied enough economic cycles, you learn something very important. No crisis is truly new. The details may differ, the characters may vary, the politics may change, but the underlying patterns repeat. And what China is experiencing today has a very clear historical echo. It resembles Japan in the late 1980s. Now, before I go deeper, let me be clear. China is not Japan. Different demographics, different political system, different ideology, different global position. But the underlying pattern, the rhythm of the cycle, the logic of the stresses, the behavior of institutions, the reaction of households, These are all familiar if you take a step back. Japan in the 1980s had one of the strongest economic booms in modern history. Incredible growth. Surging property prices, a stock market that seemed untouchable. Companies expanding rapidly. Banks lending aggressively. Real estate becoming the foundation of national wealth. Sound familiar? The Japanese public believed that land prices could never fall. Banks believed corporate giants could never fail. Regulators believed growth could be managed forever. Every layer of the system developed the same assumption, that the upward momentum would last, that the model was stable, that success would continue as long as confidence was maintained. But underneath all this optimism, leverage was building. Companies borrowed too much. Banks lent too freely. Households became too confident in rising asset prices. Land values became disconnected from reality. Speculation grew. And eventually the system reached a point where growth could no longer be pushed forward by credit alone. China is standing in a similar place today. The first parallel is the role of property. In Japan, land became the ultimate store of wealth. Families bought it as savings. Companies used it as collateral. Banks considered it the safest asset in the world. When land values stopped rising, everything connected to the financial system slowed. When values declined, the system entered decades of stagnation. China's property market plays the same emotional and financial role. When confidence in property weakens, the entire economic system feels the pressure. The second parallel is institutional reluctance to admit losses. In Japan, banks refused to recognize the scale of bad loans. They rolled debt forward. They extended credit to companies that were already failing. They hoped the economy would recover enough to make the losses vanish. It never happened. And the delay made the damage worse. China's banks are doing something very similar. They restructure loans quietly. They extend deadlines. They avoid marking losses. They depend on government guidance rather than independent assessment. It is the same mindset. Delay recognition. Protect the system. Hope for a rebound. The third parallel is demographic pressure. Japan entered its crisis with a population that was aging rapidly. Fewer young workers, fewer new households, fewer new buyers for property. China is now facing the fastest aging population in modern history. A shrinking workforce, fewer marriages, fewer births, and therefore fewer property buyers. When demographics contract, property-driven growth loses its engine. The fourth parallel is the illusion of permanent export strength. For years, Japan's export sector dominated global markets. Cars, electronics, machinery. Japanese companies seemed unstoppable. Then the global environment shifted. Demand changed, currency pressures rose. Protectionist policies appeared. Companies lost their edge. China now faces similar challenges, rising labor costs. New global supply chains. Nations diversifying away from dependence on Chinese manufacturing. A geopolitical climate that is less welcoming. Export power remains strong but not unquestionable. The fifth parallel is psychological. In both Japan and China, the public developed a strong belief in national economic exceptionalism. A quiet confidence that the model was superior. That leadership would always maintain stability. That growth was predictable. But economic cycles do not obey national stories. They obey mathematics. They obey incentives. They obey human behavior. And when belief runs ahead of fundamentals, the correction is always painful. But there is another historical parallel. One that is less often discussed but equally important. The United States in 2008. That was a moment when the financial system discovered the true cost of hidden leverage. Risk buried inside complex loans. Trust in institutions shaken. A sudden realization that the numbers did not match the reality. And once confidence cracked, the ripple effects traveled everywhere. Banks, households, markets, governments, China's hidden debt, hidden losses, and hidden stress resemble that pattern as well. Not identical, not perfect, but similar enough to matter. When you step back, what you see is not a repeat of Japan or the United States. What you see is the universal rhythm of an economy that has grown too fast on credit, too dependent on property, too confident in stability, and too slow to confront structural weaknesses. History never repeats itself exactly, but it always offers a warning. And China is now standing inside a moment that history has written before. The question is not whether the pattern exists. The question is how China will respond to it. Will the system adapt? Or will the system tighten control and hope the cycle reverses on its own? That is the question that leads us to the next stage of this story. Because every historical parallel eventually meets its breaking point. Every financial story eventually reaches a moment when quiet stress turns into visible strain. A moment when the system can no longer absorb pressure silently. A moment when decisions that seemed unimaginable a few years earlier become unavoidable. Economies do not drift into crisis. They reach a point where the choices narrow. And China is approaching that stage. This is the moment I call the breaking point. Not because everything collapses at once, but because the system must choose between actions that all carry consequences. Act too slowly and the problem worsens. Act too aggressively and you risk triggering the exact fear you are trying to avoid. The breaking point is when waiting becomes more dangerous than acting. China has arrived at this place for one simple reason. The problems that were once contained inside the property sector have now spread across every major pillar of the economy. Property developers cannot pay their debts. Local governments cannot fund their budgets. Banks cannot admit losses. Households do not trust the market. Shadow lenders are collapsing quietly. And regulators are trying to manage all of this without revealing the true depth of the stress. The pressure has reached a level where silence is no longer a strategy. A system must take a direction. One of the clearest signs of this breaking point is the dilemma facing China's central government. For years, Beijing could stimulate growth through targeted spending, easy credit, or large-scale infrastructure projects. But today, the tools are less effective. Infrastructure spending adds more debt to an already stretched system. Credit expansion risks increasing bad loans at a time when banks can barely manage the ones they already have. And direct support for consumers is limited by structural constraints, yet doing nothing is not an option. Consumer confidence continues to weaken, youth unemployment remains high. Property sales are falling. And local governments are signaling distress in ways that cannot be hidden much longer. The central government must choose between painful reforms, costly rescues, or a combination that carries its own challenges. The first choice is large-scale intervention in the property sector. Finish all stalled projects. Rescue major developers. Restore confidence through visible action. But this approach requires enormous spending. It risks rewarding poor decisions. And it forces the government to assume liabilities that could weaken the national balance sheet for years to come. The second choice is allowing more developers and local financing vehicles to fail. This would clean out excesses, reset the market, and bring transparency. But it also risks spreading fear among households and investors. It could cause bank runs in regions where trust is already thin. And it could create social unrest in areas where people are waiting for unfinished apartments. The third choice is a controlled restructuring of the entire property sector. Consolidate developers. Merge failing lenders into stronger banks. Restructure local government debt. Provide support for households while forcing institutions to recognize losses gradually. This is the option that appears most balanced. But it requires political will, transparency, and coordination across many layers of the system. That is not easy, in a structure built on tight control and limited disclosure. This is only one part of the breaking point. The second part is social. The mortgage boycotts we mentioned earlier were not just financial events. They were expressions of frustration. When tens of thousands of families refused to pay for apartments that were never built, it reveals a shift in public sentiment that cannot be ignored. Trust in the property market is not simply weakened. It is damaged. When trust is damaged, restoring it becomes far more expensive. Governments can inject liquidity into banks. They can restructure developers. They can rescue local governments. But they cannot force a family to buy a home. They cannot order citizens to believe that an unfinished tower will eventually become a safe investment. Confidence is not created by policy. It is created by experience. And millions of families now carry the experience of being disappointed. The third part of the breaking point concerns China's currency and foreign reserves. Capital outflows are rising quietly. Wealthy families are moving money abroad. Corporations are shifting assets. International investors are reducing exposure. And the central bank must carefully manage the currency to avoid further panic. A weaker currency can help exports, but it also increases the cost of imports and reduces the purchasing power of households. Managing the currency becomes a balancing act. At this stage, the government faces another difficult choice. allow the currency to fall and risk accelerating capital outflows, or support the currency and risk draining reserves. Neither option is clean. Both carry risks. This is what a breaking point looks like. Not a single dramatic event, but a tightening circle of decisions. A narrowing path where every step has consequences. The system that once looked unshakable now faces a moment where bold action is required, but every action carries danger, and beneath all of this lies a deeper truth. China's economic model relied on confidence in constant growth. A belief that property values would rise forever. A belief that the central government could fix any problem instantly. A belief that institutions were stable beyond question. When those beliefs weaken, the entire foundation of the model begins to shift. China is not collapsing. That is not how major economies usually fall. But China is entering the stage where the next decisions will shape its future for decades. The breaking point is not the end. It is the moment when the choices begin to define the outcome. And that brings us to what comes next. Because after every breaking point, there is a fork in the road. When a system reaches its breaking point, the next stage is not collapse. The next stage is choice. Every major economy that has faced structural strain eventually arrives at a moment where the path forward splits. A fork in the road. And this is where China stands today. Not at the edge of disaster, but at the crossroads between three possible futures. None of them easy. All of them consequential. The most important thing to understand is that China still has enormous capacity, strong institutions, large reserves, a disciplined central government, a powerful industrial base, a population that has endured major challenges before. The situation is serious, but it is not hopeless. It is a moment where decisions matter more than momentum, where policy choices will shape the next decade. Let us look at the three paths ahead. Path 1. The Great Rescue ***. This is the path where the central government steps in decisively. Massive funding to complete every unfinished apartment. Direct liquidity injections into developers. Large-scale buying of land by state enterprises. Support programs for households. And a restructuring of debt carried out quietly behind the scenes. This approach would restore confidence quickly. Families would see construction resume. Developers would stabilize. Local governments would receive lifelines. Banks would avoid recognizing losses that could shake the system. But this option comes with a price. A giant rescue transfers private losses to the national balance sheet. It increases government debt. It creates dependence on central support. It delays needed reforms in risk management. And it reinforces the belief that the state will always intervene. Short-term stability, long-term burden. This is a path China can take, but it is a path that repeats the same pattern that brought the country here. Path 2. The hard reset ***. This is the most painful option. It involves letting weak developers fail, letting local financing vehicles restructure, letting banks recognize losses, letting property prices fall to realistic levels, and letting the market correct decades of excess. This path is similar to what the United States did after the 2008 crisis, but with one major difference. China's system is not designed for open failure. Social stability is central to the national strategy. So, allowing widespread defaults carries risks. The hard reset path would mean developers go bankrupt. Unfinished projects are absorbed by the government over time. Local governments face austerity. Banks confront their loan losses openly. Weaker financial entities merge or disappear. Property prices fall to levels that match real demand. The long-term result would be a healthier financial system. Cleaner balance sheets, more realistic expectations. A shift from property-driven growth toward productive growth. But the short-term pain would be significant. Job losses, protests, social dissatisfaction, regions under strain. A slower economy during the transition. This is the honest path, but not the easy one. Path 3. The controlled transition ***. This is the most likely path, the middle road. The one China has historically chosen in previous moments of stress. It is a mix of rescue and reform. A combination of support and discipline. The government allows some developers to fail, but rescues others. It lets property prices adjust slowly rather than sharply. It restructures local government debt gradually. It forces consolidation among banks and developers. It encourages households to buy by offering incentives. It provides liquidity when needed, but not enough to reignite the property bubble. This approach buys time. And time is a powerful tool when used wisely. The controlled transition path would likely include targeted bailouts, centralized takeover of unfinished projects, gradual release of liquidity, encouragement for private consumption, expansion of social support programs, slow controlled correction of property values, quiet restructuring of debt across multiple institutions. The goal is not to prevent a correction. The goal is to manage it, to reduce the shock, to avoid panic, to keep the system stable while shifting the economy away from dependence on property. This approach recognizes the problem, but refuses to let the solution come all at once. It is slower than the hard reset, but less risky. It is less impressive than the Great Rescue, but more sustainable. Which path will China take? No one can say with certainty because systems this large do not move in straight lines. They adjust. They adapt. They shift strategy as conditions change. China may attempt a mixture of all three paths before settling on the one that works. But here's the important part. Each path leads to a different future. If China chooses the Great Rescue, it stabilizes today while increasing the weight of tomorrow. If China chooses the hard reset, it suffers today while clearing the path for stronger long-term growth. If China chooses the controlled transition, it walks a narrow bridge between stability and reform, hoping to maintain balance long enough to reach safer ground. These choices are not only economic. They are political, social, structural. They define trust between households and the state. They shape China's position in global markets. And they determine whether the country enters a lost decade, a managed slowdown, or a stable recovery. The fork in the road does not decide the outcome by itself. The decisions made at this fork decide the outcome. And China is now in the position where every step will carry consequences that echo for years. And as we move toward the conclusion of this story, there is something we need to examine closely. Not the events, not the numbers, but the lessons. The truths no one wants to face when a system built on confidence begins to show its limits. That is where we go next. There comes a point in every financial story when the numbers stop being the most important part. The charts lose meaning, the forecasts lose precision, and what remains are the lessons. The hard truths that no one likes to face, but everyone eventually must. When you strip away the policies, the politics, the headlines, and the noise, you are left with the principles that govern every system, every institution, and every cycle. China is no exception. The first lesson is simple, but often ignored. No economy can defy gravity forever. For years, China pushed growth beyond what fundamentals allowed. Massive construction, easy credit, endless expansion. And it worked for a long time because the country needed development. But every economy reaches a point where future demand cannot justify present investment. China built cities faster than people could fill them. It built supply faster than consumption could grow. It built confidence faster than income could support. This does not mean the growth was fake. It means the growth was accelerated. And acceleration eventually gives way to slowdown. Every nation that relies on debt-driven expansion eventually meets this reality. The second lesson is even more important. Confidence is stronger than policy. Governments can direct banks. They can guide markets. They can shape incentives. But they cannot command trust. Trust is earned slowly and lost quickly. When Chinese families saw unfinished buildings, when they heard news of struggling developers, when they watched mortgage boycotts spread, the belief that property was safe began to fade. A system built on confidence cannot thrive when confidence weakens. No central order can force a family to invest their life savings into a market they no longer believe in. That is a lesson most leaders underestimate. The third lesson is one that every investor learns eventually. Hidden risks do not disappear. They accumulate. For years, China managed its economy with quiet adjustments. It smoothed over challenges. It absorbed losses within state institutions. It delayed recognition of bad loans. It pushed debt into local financing vehicles. It handed out instructions instead of allowing markets to clear. This created stability in the short term, but it also allowed risks to grow beneath the surface. Local governance did not reform. Developers did not slow down. Banks did not strengthen their balance sheets. Everyone believed someone else would handle the problem later. later, has arrived. The fourth lesson is structural. Demographics shape destiny. China's workforce is shrinking. Its population is aging. Fewer young families are entering the housing market. Fewer children are being born. In an economy where property once symbolized growth and prosperity, this demographic shift creates long-term pressure. A society that expected endless expansion now faces the reality of slower demand. This does not doom the system, but it reshapes it. Demographics are not a headline event. They are a slow force. And slow forces always win. The fifth lesson is about transparency. You cannot manage what you refuse to measure. When financial data disappears, when debt is hidden, when losses are buried inside opaque institutions, when regulators restrict negative reporting, the system becomes harder to navigate. Investors lose clarity, businesses lose visibility, households lose confidence, and the government loses its ability to diagnose the problem accurately. Transparency is not an enemy of stability. Lack of transparency is. The sixth lesson is philosophical. Economic models must evolve, not repeat. China grew through construction. But no country can rely on construction forever. Eventually, the model must shift toward innovation, consumption, productivity, and services. That transition is always difficult because it requires institutions to change their habits. It requires banks to lend differently. It requires families to spend differently. It requires local governments to earn differently. It requires developers to exist differently. Economic transformation is not simply policy. It is cultural. It is structural. It is psychological. The seventh lesson is one that many nations learn the hard way. Overconfidence is more dangerous than weakness. Weak economies adapt because they must. Overconfident economies delay adaptation because they believe they can. China's leadership believed for years that the property market could be managed with guidance, that debt could be controlled without transparency, that growth could continue without structural reform. Overconfidence creates complacency. Complacency creates fragility. Strength does not come from avoiding problems. Strength comes from confronting them. The eighth lesson is universal. Every financial system reaches a moment when people matter more than policies. Households decide whether to spend. Workers decide whether to trust. Investors decide whether to participate. Savers decide whether to keep money in banks. Businesses decide whether to expand. No command can force these decisions. Real stability arises when people believe the system is fair, strong, and transparent, when they sense that institutions are not hiding weakness, when they see leaders acknowledge problems honestly. The final lesson is the most important of all. Economic cycles do not end with numbers. They end with choices. China is now in the stage where choices matter more than momentum. The path it takes will shape not just its economy, but its society, its institutions, and its place in the world. The story is not written yet. The outcome is not fixed. What happens next depends on how China applies the lessons that history has offered again and again. And before we close this story, there is one more thing to explore: a reflection. A final look at what this moment means not just for China, but for anyone watching a great economic power confront its limits. That is where we go next. When you step back from all the numbers, all the charts, all the institutions, and all the pressure points in this story, something becomes very clear. What is happening in China is not just a financial moment. It is a reminder. A reminder of how every system, no matter how large or powerful, eventually confronts the same truth. Growth has limits. Confidence has a cost. And no economy can outrun the basic laws of financial gravity forever. When we began this journey, we talked about a quiet signal: the disappearance of data, the silence that came from places that were once loud with certainty. And now at the end of this story, that same silence feels different. Not as a warning, but as a lesson. A reminder that the health of a system is rarely revealed by headlines. It is revealed by the things people stop saying, the numbers they stop sharing, the questions they quietly begin to ask. China is still a great nation. Still a powerful economy. Still a force that will shape the world for decades. But even great nations face moments when they must look inward and decide who they want to become next. Moments when strength comes not from projecting confidence, but from rebuilding it. Every long cycle in history teaches the same principle. Real stability is built from the inside out. From households that trust their future. from institutions that tell the truth, from leaders who confront problems directly, and from a public that believes the system will reward honesty rather than hide weakness. This moment in China's story is not an ending, it is a turning. A shift from momentum to maturity, from expansion to reflection, from certainty to responsibility. The next chapter will depend not on how quickly China grows, but on how honestly it repairs the foundation beneath that growth. And if there's one thing I have learned after all these years, it is that the strongest systems are not the ones that never bend. They are the ones that know how to recover when they do. So as we close this story, remember that the quiet signals always matter. They tell you where the future is heading long before anyone else sees it. And in the end, it is not the noise of a crisis that shapes an economy. It is the choices made in the silence that follows.